Good morning. Welcome to the Macro Show for Thursday, June 22nd. I'm Ryan Ritchie of the Macro team. I'm joined live in the studio by Hedgeye CEO Keith McCullough. Have any questions, put them in the comment section below. With that, Keith, I'll turn it over to you. We got a big audience today, a little free session.
Yeah, a little free session. Back by popular demand. Thanks for all the feedback. We bring back the rooster. Jonesy Buds is doing something else right now, grinding away, I think.
He's always grinding on something.
Top three things in my notebook is what we do. For those of you that are watching this for the first time, we review the top three things in global macro markets. Again, don't be a spy monkey and think that the U.S. stock market or 7 stocks is just the global economy or markets. That would be silly and amateur. We do the top three things across all of global macro. Then we get into some detail, line items of the process. Then we'll, of course, take your questions. So again, let's just start with Europe. We're going to do Europe, the yield curve, and volatility. 3 straight down days for the S&P 500, whatever. I don't have a position in that, but I do have 3 short positions in 3 specific European equity exposures, with France, Finland, and Austria being those 3 things. If that's not what you want to do, then, like as Michael Jordan would say, if you don't want to play that way, don't play that way. That's how I play the game. We're playing at a very high level here, and again, using a diversified short book as opposed to just having a short position in Qs. By the way, I don't have a short position in Qs or in SPYs anyway. So again, what's happening here is actually most global equity markets, and I could have focused on the FTSE, which is a pretty big market, obviously, in London. Down in the last month alone, the FTSE's down almost 4%, as you can see. Finland's the worst at down 4.5%, and France, big country, big part of the Eurozone, of course, economically, is down over 4%. So great returns. Again, they reflect 100% the global industrial production recession we've entered. That is called Quad 4. So again, for those of you that are new to the process, Quad 4 is when the rate of change, the rock, slows on both GDP growth and the rate of change of inflation. So for all of you people who have been, fanboys or fangirls about inflation falling, that's not good for industrial profits. Again, when inflation's accelerating and growth is accelerating at the same time, i.e. Quad 2, when we're long Europe, we're long growth, we're long crypto, for God's sakes, that's when profits accelerate. Currently, global profits are slowing, U.S. profits are slowing, and the European shorts act very well in kind. Finally, on this point about recession, let's just put a picture right there. One of the top leading indicators on a recession is hitting new lows this morning. Okay, whether or not you heard that, amidst the AI narratives at CNBC or whatever they're pumping lately into this NVIDIA board member selling $51 million worth of stock down your yap, doesn't matter, right? Again, the yield curve matters. The yield curve, look at it this morning, is at a new cycle low. That takes the 10-year yield minus the 2-year yield, and it's minus 98 basis points, okay? That is one of the worst yield curve inversions going back to the prior recession of 1981, when Volcker instead was tightening. And by the way, this is happening because Powell yesterday said, I'm the real deal. I am going to raise interest rates into a Quad 4 slowdown. He didn't say that last part. But again, we've been bearish on U.S. growth, not for 6 months or 6 days or 6 weeks, for 19 months, okay? To be very clear, I'm a selfish bastard. I only care about my own positioning. I couldn't give 2 hoots or a holler about a spy monkey. What I care about is when we got people out of growth as a factor exposure, when we got people out of credit, commodities, et cetera, and what the yield curve is doing today versus my position, the full investing cycle's position. Okay? That's what we care about. We care about our pile, not other people trying to get their pile back or their bubbles back. This morning, again, yield curve is saying the Fed's going to stay tight on the short end, and the long end, by the way, in particular, where we have a new position, the ticker is BNDD. That's Nancy Davis's ETF. That's long duration. What's happening is that the 30-year yield is saying that I'm right as well, and that's why the yield curve says that I'm right as well, because we're right on the economy, notwithstanding 7 stocks doing what they did until last Thursday's highs. Finally, on the VIX. Okay. Mechanics. And I don't care as much about that as I care about RVX, Russell volatility, because, again, I don't have a position in SPY. I have a core short position in the Russell, which last I checked is down 24% from its cycle high, okay? That's all I care about. Where is it from the cycle high? Not year to date, some other guy's compensation mechanism. Year to date, were you just trying to get paid after blowing people up last year to date? They didn't talk about year to date last year. We care about cycle to date. Hashtag CTD. And on this cycle for the VIX in particular, again, its options expiration was yesterday. So that happened. So we'll see I'm expecting to see some pin action here today. Obviously, massive suppression on the VIX due to last week's number 1 day in the history of of U.S. markets, again, in terms of call buying. The biggest call buying ever. Okay? If you don't know the math on what happens to front month volatility when people are buying the living daylights out of SPY ODTE options, do some homework. That's important. The most important thing, that's in terms of contextual understanding of what's going on, the most important thing, again, selfishly for Hedgeye Nation this morning, for everyone who has positions not in SPY, but in industrials and REITs, if you look at the board here today, this is called the implied volatility discount table, again, and or premium table. You can see that those things have tasty implied vol discounts. Now, SPY, you'd see, has a 40% implied vol premium. You go to the second column there where the numbers are, the second column of numbers, of course, it's the third column because the tickers are beside it. You can see 40% implied vol premium for, so even if you were just on that thing alone, and it's never one thing, you would choose shorting XLI and XLRE industrials and REITs respectively, and oh, we're short the fur. You got that? You got that? You heard it for the first time, didn't you? You know magma, you know magmant, you know a lot of things. But do you know about the fur? Ooh, sexy. Right? Fur, financials, industrials, real estate, and retailers. Those are our top 4 sector shorts in terms of signal strength, and those are your top 3 things. Right? What we also do every day is we learn. Unlike these bozos on Twitter and TV, I screw up a lot. Okay? So, and what you have to do when you screw up a lot and you do it transparently and accountably, to be clear, nobody, not even close, not even remotely Trumpian close, has made as many mistakes publicly as I have in the last 15 years. Now, the bar is low because nobody else timestamps any of their positions, so you wouldn't know otherwise. But the fact of the matter is that every single time I screw up, everyone knows about it. They tweet about it, they talk about it, they whine about it, they cry about it, they love me for it. All sorts of emotions. But you know what? I don't go there. I don't go there. Last Thursday, I was down 3.1% from my all-time high in the pile. It took me 24 years to build it. When I started that on Wall Street, I actually had negative pile. All I had was student loans. I'm not a big timer. I came from a working family where I had to work and earn my way. My pile means a lot to me. I'll hold it. And I'm going to preserve and protect that pile for my family. 3.1% from my all-time high. Again, all-time highs in the pile, again, there are 3 different points where my pile hit all-time highs. December, remember that? I'm old enough to remember March when the banking crisis was happening. And then actually in May, because that's when our top core short position, being the Russell, hit new cycle lows, retailers, the fur was working. All right? Now, I get a correction in my pile. Now, I make good decisions on Thursday, do hard things. I did a Q&A for our subscribers that went all the way to 10 o'clock. Usually this ends at 9:30. And I just doubled, tripled down on the process. That's doing hard things. When the entire arena is yelling at you, spitting on you, I liked it. And then I made the decisions that are embedded in the process. I didn't change the process. So that's why I've made money again for 3 straight days. And instead of being down 3.1%, I'm down 1.4. So I've made back 170 basis points in my pile. And I'm happy for my friends and my family. And that's it. Okay? So do hard things. This game is not easy. If it was just looking up a 50-day moving monkey chart, everyone would do it, and so would I. I wouldn't have to get up at 4:30 in the morning with my teammates. This rooster, what time do you get up?
4.
4. All right? Yeah, we're not always right, but we're always going to outwork you. And it takes a team to do this. It takes a lot of work. A lot of work. I always highlight the book that I'm reading. I try to keep a pace of 1 book every 10 days. There are 3 different things that I read about. Guys, show slide 5. On the left side, as a matter of process, behavioral, history, and math. Those are the 3 arenas within my discipline that I want to learn, because those are the 3 things that I can apply to my process. Okay, we'll get into the sine curve momentarily. But so this is a behavioral book. This is, again, what I love about being a polymath or being cross-discipline. David Salem, who's I think one of the preeminent thought leaders in the world in terms of asset allocation, he's recently joined our team, gave me this book. Salem's a runner. If you watch me run, I had the worst time in the 2-mile run in Yale hockey history. Horrible. You think I was bad up until Thursday last week? You should watch me run the 2-mile run against my teammates. Terrible, right? Do hard things, okay? There's a chapter in here that is called Turn the Dial So That You Don't Spiral. What do you think they're talking about there? It's trying to maintain, again, balance. When it gets hard, the biggest risk is what's in between these 2 ears. It's your emotions, okay? Are you adaptable? Are you flexible? Do you stay with your process or do you flinch? Like in a great book by Annie Duke called How to Decide. I highly encourage you to read that because it's all about decision making based on probabilities, which is what we do too, but using gambling with lower odds than what we do. But the fact of the matter is, she says the number one mistake professional gamblers who get to the highest level make is that they go on this thing called tilt. So again, when you're on tilt, you start hitting on a 6, blackjack. You start making bad decisions. You don't stay with the decision-making process because you're resulting based on what just happened over a very short-term window of time. I'm not fucking around. This is over the long time, okay? I am here to help you preserve and protect your capital and mine. It takes a long time to play out through a cycle. This is not our first rodeo. We're still in, again, the slowing side of the sine curve, and that's what I have to say about that. Those, again, just points that we want to make. We're tying back our learnings to the process because every day, I'm not going to learn anything from reading Wall Street research. I'm going to learn by standing on the shoulders of giants. I'm going to learn, again, these are the lessons of the world's best marathoners, whether it's the world's best mountaineers. This is what I'm trying to do, is get to the highest level and understand what are the similarities between what they do and what I do. I will never scale Everest. Nope. I'll never run a marathon. Nope. But I want to know how they do it, okay? And don't forget, Ed Vistiers, for those of you that are, again, Hedgeye Nation core, Ed Viesters, sorry, pardon the pronouncement. And by the way, Rooster's a mountaineer too. Getting to the summit, like we did in 2021 when we were long, that's an option, right? We did it. I'm proud of it. Getting long in April of 2009 after starting the firm being bearish in 2008, it was an option to go long there, and the process got me there, thank God, right? Getting down from cycle peaks, that's mandatory. If you don't, you die. If you lose 20, 30, 50, 80, in Rug Paul's case in Ethereum, 80 to 100% of your capital, you're dead. I don't kill people, right? I do a lot of things. That's what I'm not here to do, all right? Let's get on with the rest of the process here quickly and take your questions. So what we do here is we go through risk ranges. This is published daily. I compute them myself. If I gave away the code, somebody would steal it. We've had a bad experience with stuff like that. It's not going to happen again. S&P 500 risk range, again, and all the risk ranges are listed daily in this thing called the risk range product. So the risk range, again, today is 42.52. So that's a higher low versus where we've been. And I'll tell you why in a second. 44.26 is a lower high. Now that's versus 47.97, which is where we got people out of S&P 500. The S&P 500 is down about 9%. You have to be up 10% to get back to break even if you've been bag holding the whole way down. Again, I don't have a position in SPY. But again, this is now 2-to-1 downside versus upside because this is minus 2.6% of downside versus plus 1.4% on the upside. Okay, so my short position, like on Thursday, my long shorts in, again, this is not a portfolio, real-time alerts, but it is a good proxy for what I'm doing. In real-time alerts, I went from 3 longs and 16 shorts to this morning 5 longs and 9 shorts. That's how a pro does it. So today on red, if we get the 4th day of red, and it really depends on the tickers and what they're doing, this could easily go to 6, 7, or 8, and this could go down to 6 or 7. Then we have more longs and shorts. It's happened multiple times throughout this bull market, and accurately so. Okay? If you think I didn't do that, look it up. So again, when we get to these points, and my net position went from minus 13.3% in my long short book to minus 0.8% over a 3-day period. If I didn't go to 13.3%, if I didn't press my bets, if I didn't keep playing out that don't hit on the dealer 6, if I didn't do that, I wouldn't have made back part of my pile. All right? Critical moment Thursday was not a time to do nothing, okay? So that's where we're at on that, just to be clear. Then we rattle through a whole bunch of other data. Again, we look at signals not from a moving monkey perspective. That would be silly. It's ridiculous. People love AI, but they want to use a one-factor model to talk about charts. Like, how stupid do you have to be? And of course, people get upset when I say that because it is stupid. But the fact of the matter is that we don't do that. We don't do stupid. We don't do dumb. What we do is math, okay? We do fractal math, and we use a 3-factor model that is price, volume, and volatility, and we use 3 different durations called trade, trend, and tail. Slide 9, guys. When you look at the price, volume, volatility relationship, what has been happening, look at the volume. So again, we're showing the rate of change of everything. That's all we really care about. What is the rate of change? So we got a price down day on what? On 1-month volume being up, on 3-month volume being up. That means more selling on the down move. NVIDIA insiders sold, okay? So this is This is, whereas we've seen multiple bear market rallies where the volume, again, decelerates on the up move and volatility doesn't change in kind. So that's a real important call out this morning in as much as the implied vol table. Just to show you that one more time. Can I circle it, guys, just so I can focus the eye on people? Again, they can tell you where your 50-day moving monkey is, but if you can't tell me where implied vol is on everything that you trade, you're playing at a lower level. That's just a fact. All right, we don't want that, and neither does people in Hedgeye Nation. We want to play at the highest level, and we want to challenge ourselves and learn from our mistakes. This is what I meant, 40% implied vol premium, really no change versus where it's been. But again, this is opportunity. When we look at opportunity knocking, -9 versus +39 only a week ago. Okay, so watch the rates of change and how they change relative to themselves. The vol of vol, or the volatility of volatility, is a critical observation going back to when I built this into the process. Now, we also look at cross-asset class volatility. So again, we're going deep here for you, all right? This is free, but we're not gonna play at a low level because it's free. Move index broke trend, okay? What is the move index? It's the VIX of the bond market, just to simplify. Again, simplifying the complex, not easy in this short window of time, but the alternative is listening to Kramer. You can also watch Seinfeld this morning, but the fact of the matter is that he's been a longer standing, I gotta give it to him, a longer standing comedy show than even Seinfeld. I mean, it's amazing. This is a tremendous accomplishment. Good job, Chrome Dome Kramer. Keep going, keep pushing. Move index, 110. Now, trend is 114. So again, that's another reason why we're gonna keep grossing up this gold position. I don't buy when things go up. I'm like a lot of American shoppers. I like to buy things on sale. Yeah. So when things are down, I buy them. When gold volatility is not up, which it's not, gold volatility, by the way, is right around 13, with a range on vol of like 11 to 15 maybe. That's attractive. All right. Now I got bullish on gold in November. It was had a 17 in front of it, not a 19. So this isn't a deal like the deal we got back then. But again, it's for sale. And we have a breakdown in the volatility of the bond market, and the best longer-term leading indicator for gold is real rates, okay? So real rates falling, nominal rates falling, which again is embedded in my 30-year yield signal on the longest term. That's down to 393. That's a lower high as well this morning. Actually, the 10-year yield showed a lower high at 384. Those are all in the risk ranges. Go back to that, study it, ask questions. Go to Hedgeye University. Heck, there's a lot of there's freedom this morning, isn't there? Freedom. How many of the things have I said so far in 17 minutes have you thought about before? I don't know, but this is what I do, and I'm proud to talk about it. What else we got going on for you this morning? Japan finally had a down day. I mean, even yesterday was alpha day, right? Because we had my small cap Japanese exposure, my mainline Japanese index exposure. They were up with U.S. equities down. It was a big alpha day. That's how I made my pile, or at least part of my pile, back and heading back towards the ATH's all-time highs. Also, Australia. So we're going to buy the damn dips in Japan. That's our number one equity allocation. It's outperformed even the NASDAQ from when I bought it, which again is when I selfishly care about it. I don't care about what gold did before November of last year. I was not long it. Now I'm long it. So I get long it from there. That's where the game starts. When we bought Japan, that's where the game starts. From my duration, it's been fantastic. So long Japanese equities, reiterated. Warren Buffett agrees with the two, and you didn't need him to do that. It's called Quad 1. That's when the rate of change of inflation is slowing and real growth is accelerating. It's not the same as USA. That's why we have a different asset allocation decision. Now, the short side is Australia. We pressed that short a couple days ago. If you weren't on the show because you're just watching for the first time, doesn't mean it didn't happen. That's called a big alpha position. Today, in the early look, I show the top 6 short positions that I have, and I didn't give you the size because I don't want to get squeezed from somebody's center buck. Okay? I hope you can appreciate that. I'll show a little bit, but I'm not going to show everything all the time. Right? I'm Irish. Australia is down 1.7% last night. So why do you care? For those that are power users, you shouldn't care if you're short a unit of Russell 2000 or a unit of All Ordinaries or EWA in Australia. You shouldn't care. It's just short inventory, and you got to move your inventory. So again, I'll be covering EWA today, some more of that. And I'll be adding to anything that's up. Yesterday I was adding to XOP, my energy shorts, which have been fantastic. You don't hear any energy bulls on Twitter anymore because I think they died. What else we got going on for you this morning? We're long India, big meeting for Modi today with a lot of executives. That's big time. We're long INDA, that's India. We're long South Korea, which was up 0.4% last night, EWY. We got longs. Oh yeah, they're just not the longs that everybody in America owns. You love that, huh? What else we got? I already talked about FTSE, CAC 40. That looks like CAC. Something else, caca. Yeah, CAC 40 is, of course, en français, and caca is It's act like shite. Let's just combine the Irish with the French. It acts like shite. My mom was French, first language French, and my dad's Irish, so that's why I have all these issues. Anyway, moving along, Finland down again. We already talked about that. Commodities. Oh, I can't see the quad 4. What are you, fucking blind? I mean, look at oil. I mean, look at even they're going after this stuff this morning. Butter, orange juice. I mean, are you measuring and mapping everything or not? You probably can't. So, that's why people pay us to do it. And then they check against their process, or they just adopt our process in and of itself. Crude, I mean, is this a chart of demand accelerating? It's a chart of a big thing in macro called oil. So again, you can't see, you hear, holy moly, Mike Santoro! He's like giving, well, it kind of looks like, it feels like, it looks like. He's talking about the economy I don't even know what you're saying, Mike, because you don't know. The economy is slowing to quad 4, and it, again, from an industrial production perspective, here, I don't know if Mike can read this number, but 0.2%, maybe he's watching. That's industrial production growth. It slowed from 7 to 5 to 2 to 0.2. They can't, it's an orderly landing of the plane. Like, what the fuck are you talking about? Like, nothing. It's just noise. Turn it off. Turn this on again tomorrow. Here you get the latest update on all this stuff, and that is how we roll. Copper, short that. That's at the top end of the range. Wheat, shorted that into the close. That's down 1%. Already this morning, so if you're not shorted, I wouldn't mind. I mean, I don't stand against shorting some now. ETF for wheat is WEAT. Already talked about the butter. The corn's down a little bit here too. Talked about bond yields. Our biggest long position in currency terms, again, we wouldn't just be a monkey. We're long dollars against yens. Those signaled overbought in the last 2 days, so I took my long dollar position down from a 5% asset allocation to 3%, because I sell on strength, I buy the damn dips. It's pretty straightforward to understand. Buy low, sell high. I know you're with me now. What else we got going on? Euro. Good. I covered the short yesterday in real-time alerts. I said I have no idea why Floki, the fractal signal. He says cover your euro short. I said, okay, I didn't ask for a fundamental reason why. I certainly didn't call Kramer. I mean, this is what we're doing here. We listen to the fractal math. It signals to act, and that is beauty, right? That's fractal beauty. Because I determined a long time ago that if I went with what's inside of my head, what I fundamentally think, as opposed to the signal, I'm screwed, right? I am not as smart as all these people on TV. I'm very low, like lowest SAT score at Yale, low level, so I listen to the gods. AI, like fractals, come on. I mean, why wouldn't you listen to the gods? I love that. I shorted the Maestro yesterday.
Right at the top end of the range.
You know what the best part about that? MSTR. Michael Saylor, when he told me, Keith, you got to believe in something. He was evangelizing about crypto and Bitcoin. Bitcoin, maybe. I'm like, yeah, I believe in my process. And I believe I shorted MSTR yesterday with no borrow. That's great. I've had to pay a big borrow on this guy for a long time. Yeah. And I don't know why yesterday. What a deal. I guess because crypto was up yesterday and the related Bitcoin equities. But the risk range on MSTR is in our crypto tracker product. We got Coinbase, MSTR, et cetera in there. The low end of the range is 256. So back to this risk range thing. 256 is the low end of the range. LRR, hashtag. That's 23% below yesterday's closing price with no borrow to pay. Please, don't be a monkey. You build a diversified short book, everything from MSTR to France and back again. We reviewed it. Let's take some questions.
But quick point on that, right? Your short position MSTR, there's no way it's 10% or anything, right?
No, it's 1.
Right, very small.
1.
Right.
Okay, lesson.
Very important.
Quickly. Here's question number 1. I'm going to ask myself instead of the queue. Keith, what does a typical long-short portfolio construction look like if it's just stocks? Because I know a lot of you guys don't do macro. You do stocks, right? You love stocks. You got your ass handed to you in stocks from November to June, right? Remember that? I'm old enough to remember these things. So if you have a long-short book and it's just stocks, here's basic portfolio construction. This is, again, max. This is min. Okay? My minimum short position is 0.5%. Usually I come in at 50 basis points to add a new position. Yesterday, just because I was getting all greedy, I went to 1 on MSTR. All right? That's just one position. That's it. That's it. Don't make it like 40% short position like some people made Tesla, or like Like literally, this is the most basic. This is like putting on your skates. Playing at the highest level with your skates on is an entirely different thing. But if you come in here and you have like 30% short positions in Qs and Tesla, no wonder why you're pissed off. You don't know what the hell you're doing. You should be pissed off.
Yeah. I'll go to the first question here. It's about gold. You hit on gold, but I'm going to put my own twist on this a little bit at the end. So it says, hey, Coach, I added to gold today, both quad 1 and Q3 being the current forecast. Should my allocation remain small here? And my question on this is basically, could you explain the difference between this quad 1 and a lot of people started trading in 2020, right? And not quad 1 in terms of the pace of acceleration.
Oh, yeah. Big difference. Okay, so let's just go, let's do a quick tutorial on, let's do slide 5 and slide 13. We're going to do those two core slides in the macro deck. One is foundational, just to remind people, and yesterday we had a good moment, the last 5 minutes, I think we're reviewing the sine curve, okay? Yep. So all I care about, this is it, is the rate of change. Where are you on the sine curve, okay? So when you came into the initial quad 1, by the way, you're coming off this bottom part of the sine curve. I'll show you what that was in a second. It was like minus 9% GDP. The actual cycle high for GDP ended up being 12.5. That means that GDP, the cycle, went from pandemic minus 9, worst number ever, to accelerating to 12. That's essentially why you have the mother of all bubbles, Moab. Now, whoever wants to say that Moab didn't exist because Keith McCullough got his ass handed to him up until last Thursday for a little while is an idiot, right? This is just rate of change math. That's not subject to opinion, okay? So then we had a slowdown from that cycle peak, but essentially, the ultimate cycle peak was on a reacceleration in the fourth quarter of 2021, all right? Now, all we're doing here, now GDP has obviously gone, and I'll show you this in a second, it's an empirical fact, GDP has gone from, it's gone down, so the color, when you start to go this way, down the sine curve, is bad, okay? And each quarter, this is what it's done, okay? GDP has gone from 6 to 2, now currently we have it tracking on a year-over-year basis around 1.3%. We have it by the fourth quarter going to 0.8 or 9%. And at some point here, you're going to find the bottom. Why would I change my process because a guy named Jensen makes everyone run around with their hair on fire? I mean, it says bullish trend on NVIDIA, by the way. My signal sniffed that out, having known nothing about AI, other than that we've been building it and using it for 15 years. But the fact of the matter is that this is what matters, okay? So let's go back to answering the question on slide 13, all right? So on slide 13, these are the actual numbers, not subject to debate or how Holy Moly feels about it or Kramer opining on it. That's just unequivocal comedy, right? In some cases, it's like a satire. But again, what I say, GDP went from down here, like the lows, accelerated. You get bubbles. Everyone wants these bubbles back, by the way. Remember SPAC Jesus in there? That's Q1 of 2021. That's the peak. This is the reacceleration to the Q4 21 peak. Q4 of 21 is when everything from Bitcoin is 68,000, Qs at all-time highs, same week, IWM, Russell 2000, all-time highs. All that happened here. Since then, this is what GDP's done. Went down, you had a disaster into December of last year. Oh, then the economy actually accelerated, in particular in January of this year. Then it started to slow again, and we have this slowing, just to use the right colors. This is bad, this was good, and now we're going back to bad, which is a 0 handle on GDP. So the difference between quad 1 in 2021 is going from, the delta there is going from minus 9 to minus 2. That's 700 basis points alone.
Yeah.
Right, again, going from bad to less bad is good. This quad 1, like this one's like 8 basis points in here. 138 to 147 with downside to 110. Again, there's at least 20 to 30 basis points of standard error in the model that we're willing to accept. But this is a non-recovery. This is no acceleration. Everyone wants to live in this acceleration because they did. Think of all the people that you talked to that fundamentally got their ass handed to them last year, from the November highs, that are right back to doing the same stupid shit, right? Meme stocks, all the same stocks, whatever they're chasing that day. They have no idea what they're doing. They have no idea about anything that I just said. Again, we're talking about at least 80 to 90% of people out there that participate in markets. We want you to be in the 1, 2, 3, 5% As I've said many times, I think only about 250,000 people have the capacity to understand the full, have the experience and capacity to understand the full investing cycle and execute on it in full, because these things called emotions get in their way. And their old wall baggage does too.
Yeah. I'll go just run out of time here. I'll just do, I guess, one last question here. It says, over the last 2 trading days, the VIX has been down alongside the SPX. Is there anything specific that causes this dynamic?
Yeah, we already talked about that. Let's talk about Tesla. Tesla, so here's a part of the bubble, okay? Now, you can call me whatever you want. You can say it's not the mother of all bubbles. You could say it wasn't. I call absolute 100% bullshit to your face on that, and I highly doubt that you call me bullshit to my face. That said, if you want to get in bed with Telecom Tom and talk about some kind of re-acceleration when there's no numbers accelerating, you can do that, right? If you want to go live and you want to do anything, right? You want at parties, people do cocaine. I don't do that, right? I mean, you can go do whatever you want. But whatever you say, I will not believe that this is not the mother of all bubbles in terms of behavior in Tesla alone, okay? So let's look at yesterday. Like yesterday, intraday signals, people say, okay, look, what is going on with this 0 days to expiration bubble, which is an unequivocal bubble? It's the shortest term duration with the most leverage you could use, gambling your money. And you have center books and big institutional books that are gaming the game because they know that human beings are dumb enough to play it, okay? Until it stops. You know, when the music stops, you're gonna see quite an affair like you did last year. So when we measure and map this, when I look at the ODTE board, and or the weeklies, okay? Weeklies, these are options. There's this thing called the most actives, okay? So this most actives board, which you'll see me tweet about. I just look at the board I look at it 6 different times in the day as a matter of discipline because I don't want to waste my time staring at something all day long. It's like watching your dog all day long. No, I gotta feed him twice. I look at this 6 times. So I give it more attention than Boomer. That's my dog. So ODT and weeklies. Generally speaking, at the top of the board, you can see the manipulators out there, the institutional ones, what line they're pushing. So yesterday was really interesting because they were pushing early in the morning. They're trying to get a rally to happen. And it generally happens when the volume's drying up because that's when you can really bully the market. They were pushing the C436 calls. Okay, that's spies. Okay, and it failed. Intraday fail. The bigger fail was right on the open. They went right for it one more time. They went for the Tesla 280s. These are the weeklies. Okay, now this is a game to behold. I mean, they yesterday bought over 125,000 call options, and then it failed. And then it failed at 275. And where'd Tesla close? Well, you can look it up. That's signal. That is signal. When this game stops, and it has multiple times, I'm old enough to remember when Tesla got hammered at the beginning of this year again. It just goes the other way. So these should have been, like when you look at what happened yesterday, you look at that, and the other thing that's manipulated quite a bit are these, or chased and pushed, are these Goldman baskets. Okay, so you got like the crazy ones are the most rolling short basket, most Bitcoin sensitive basket, profitless tech basket, high retail sentiment is a beauty. That's what all people who have no idea what they're doing own the most of, right? Yesterday, those baskets, high retail sentiment was down 2.9%, profitless tech was down 2.3%. The music stopped, and it will again. And we're going to be here every single day trying to risk manage it within our process. Whoever fundamentally believes that this is normal, that this is the future, that this isn't the mother of all bubbles, irrespective of the rate of change of Microsoft or NVIDIA's business, which, by the way, accelerated, and say bullish trend on the Hedgeye products across the board for that reason. People can say whatever they want. And we may never see you again, because this is a free one. But over my dead body, and again, I did it in 08, went bullish in April of 09, over my dead body, am I going to take what you want and what you need, which is your bubble back, in place of my process.
And we'll wrap it up there. Thank you, everybody, for joining us. Hope to see you guys, everybody, because we do this every day. So we'll be back at it tomorrow. Good luck out there.